Quarterly reports can be like truth serum for companies. They actually have to record exactly what they're doing from a revenue perspective, how much it costs to generate that revenue. It's not necessarily about the story, although you can still tell a story with the numbers. It's about the numbers matching up with the story that you're telling investors. And we learned in the second quarter of 2024 that Plug Power continues to tell a great story, but the numbers just don't back that up. And this is something that's been consistent with this company over the last 2 decades, really. I want to go through the quarterly numbers and show just how bad they are at Plug Power, but I also want to put it into context about what management has been saying and doing for the last 10 to 15 years. This is a company that has long told a story about what a massive market it is, how much growth they're going to have, how close they are to profitability, and they never get there. And investors end up paying for that through dilution. The dilution numbers are absolutely astounding with Plug Power. But I'm going to dig into that today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's get to what we learned in the second quarter. Here's the financial highlights for the quarter. You can see that revenue was $143.4 million. They actually deployed a pretty large electrolyzer. Most of that was not recorded in the quarter. But this is the number that is just astounding, and this is consistent quarter after quarter for Plug Power, $262.3 million in net loss for the quarter. I'm going to get to the cash flow and what we learned about their cash flow statement, but some of this was non-cash charges for things like stock-based compensation, provisions for common stock warrants, again, one of those dilutions that I talked about earlier, but no way to sugarcoat it. If you're reporting a $262 million loss on $143 million in revenue, not a great business. I want to just highlight some of these numbers here because if you go back with Plug Power, what you should really be looking at is where does the company actually make money? Where does any gross margin for the company come from? Because the thing that's always shocking is, sure, they generated $143.4 million in revenue. That's great. But the gross loss was $131.3 million. So they can't even make a gross profit. They can't cover their operating costs. They can't even cover their expenses just to make the thing that they're selling. So let's go through each of these. Sales of equipment, related infrastructure, and other. $76.8 million. How much did it cost to sell that equipment? $130 million. This is not new. For the first 6 months of the year, $145.1 million in revenue. And it cost $265 million to generate that revenue. Now, the company has generated a small gross profit in the past. You can see that here in the first 6 months of 2023. But that gross profit from sales of equipment is offset by other costs in the business. Services platformed on fuel cell systems and related infrastructure. That's another revenue line item. $13.0 million in revenue. Cost just a little bit more than that to generate that revenue. But again, if you go back further, the losses were enormous last year. $17.8 million in revenue, $36 million worth of cost. Power purchase agreements. This is something that should be very profitable. If you are selling a power purchase agreement, you should know what the costs are going into that agreement and what the revenue is going to be for that agreement. Doesn't seem like Plug Power can do that. $19.7 million in revenue. Power purchase agreement cost $54.3 million. Again, this is something that is consistent. You can go to 2024, the first 6 months, about $38 million in revenue on $110 million in costs. Last year, $24 million in revenue, $101 million worth of cost. Fuel delivered to customers, also generating significant losses, almost 100% loss in the most recent quarter, and it has even been worse than that in the past. So this is the fundamental problem for Plug Power. How in the world are they going to make money? Sure, they always talk about how much revenue growth they're going to have. That's great. But if you're going to lose more money as you grow revenue, that is simply an unsustainable business. And if you think this is a one-time aberration for Plug Power, it's not. This is a chart that goes back all the way to 2014, and this is just gross profit. So revenue is in the light blue, gross profit is in dark blue. So you can see that they have not generated a consistent gross profit in the last decade. This is as far back as this chart goes from FinChat. So that's not a sustainable business. Now, we haven't even talked about operating expenses. They did cut some SG&A expenses, but these operating expenses are basically just as much as the gross loss. So that's how you get this massive operating loss. I'll show the same chart, and this is revenue and operating losses. So as Plug Power's revenue grows, their operating losses get even worse. Why is this a problem? Because you have to use cash if you are losing that much money. So $422.5 million worth of cash used from operating activities in the first 6 months of the year. That's down from $625 million a year ago, but still not a sustainable level. And cash is now starting to be a really big challenge. $62.4 million worth of cash sitting on the balance sheet. There's restricted cash. Management talked about this. Some of that cash becomes available over the next few quarters. I believe it was in $50 million tranches each quarter. But they're going to need cash to just simply keep the business running. And where does that cash come from? Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This chart just shows how much cash the company burns on a free cash flow basis. So like I said before, revenue grows, free cash flow gets even worse. Now you can get cash from two places. You can get cash through debt markets and you can get cash through equity markets. So Plug Power has done both. You can see that debt has increased pretty significantly. Right now sitting at about $450 million worth of debt on the balance sheet. That has increased from essentially no debt 10 years ago. But the other thing that they've done is they have sold stock. Now, some of this stock they have sold through warrants. Some of these came with purchase agreements. So customers would say, hey, sure, we'll purchase your product, but we also want some warrants for stock in your company. So basically, we'll pay for what we're getting, but then we also get to keep the upside if your stock ends up going up. That has been extremely dilutive over the last 15 years for Plug Power. Amazon and Walmart were the two big companies that did that. They had basically identical deals. And that's why the share count has more than quadrupled in the last 10 years. If you're generating those kinds of losses, you need money to end up funding your business. And Plug Power keeps going back to markets over and over again. Now, the reason that this is different today than it was 10 years ago is the stock price is extremely low, now about $2 per share. The company has debt on the balance sheet, so you're probably not going to be able to go back to debt markets and ask for more debt. And the scale of the problem is so much bigger than it's ever been before. When you have the kind of cash burn that Plug Power has, you're going to need to raise billions of dollars. And it doesn't look like debt markets are going to be open to do that. Are equity markets going to be open to do that? I really question that long term. And I think we're in the point now where the stock has fallen enough that this could be a downward spiral, a downward death spiral for Plug Power. Now, the company has survived by just simply issuing more stock over the course of the last 20 years. I don't think that's going to continue forever. And that's fundamentally the challenge for Plug Power. If you can't make money selling the products that you're making, if you can't even make a gross profit, how are you going to be a sustainable business long term? Eventually, you have to answer that question. I don't think Plug Power has a good answer. But let me know what you think in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.